now looking at the lending space, it seems like a lot of the lending has moved from the centralized businesses directly to on-chain, and I think that's a really exciting progress. And now what we're trying to figure out is that how do you take this on-chain lending activity and scale it to the mainstream, to institutions and to consumers, but doing it in a way where you benefit from the DeFi liquidity network effects. And that's what V4 is all about.
We are going to talk about Aave, which is obviously the largest DeFi protocol out there with over $40 billion in total value locked, I believe. And that is across 12 networks, including Avalanche. And the launch of V3 came in 2022. And now Aave is on the road to V4. And essentially, it is the latest architectural upgrade proposal, which you've described as a generational upgrade. Do you want to talk more about that and why now?
Yeah, I mean, kind of a good context is, how we got here. So obviously, Aave is a very unique project in the sense that we started it very early in 2017 as of ETHLend, focusing on peer-to-peer lending, and later converted it into more of a pooled model where you can supply different kinds of assets, stablecoins, for example, earn yield, and borrow against liquidity. And I think kind of like a big momentum for the whole DeFi space was 2020 when we launched the Aave V1, when it was still COVID, and the macroeconomy was in a state where pretty much the economy wasn't moving and interest rates were extremely low at the moment. And a lot of users were trying to find ways of finding yield. So DeFi at that point was kind of like an attractive alternative way of preserving capital in a very extreme environment of COVID. And then DeFi Summer came in and really showed that you can actually decentralize some of these protocols that are financial infrastructure, and that people should be able to own them and participate in open governance and have a saying. And I think now in 2025, Aave has been growing substantially. We had the best year so far last year. And I think what's been really remarkable is that when we started building Aave, there was a lot of centralized lenders out there, and we couldn't compete with our path because we chose to build something that is non-custodial, resilient, fully on smart contracts. So the speed that you can move is very slow. And now looking at the lending space, it seems like a lot of the lending has moved from the centralized businesses directly to on-chain. And I think that's a really exciting progress. And now what we're trying to figure out is that how do you take this on-chain lending activity and scale it to the mainstream, to institutions and to consumers, but doing it in a way where you benefit from the DeFi liquidity network effects. And that's what V4 is all about, is introducing a new architecture of liquidity hubs and liquidity spokes where you can segregate risk very granularly depending on different types of use cases, but at the same time you benefit from the liquidity network effects that Aave, for example, provides today, where you can supply assets into the same pool and have instant liquidity. As of example, Aave is the only place where you can actually borrow billions worth of stablecoin liquidity with one transaction as long as you post a collateral. So it's simply a innovation towards a direction where we take the best things that exist in DeFi, the ability to pull liquidity in a very permissionless way and have these benefits, and doing it in a safe way where you have risk segregation.
You said the best things in DeFi. What would you define that as today in the existing market? And you mentioned last year that Aave also had its best year yet. Do you think this V4 will kind of propel it even further this year and so on?
Well, the launch obviously is going to be very controlled because when we produce technology, we want to ensure that it's safe and secure. And that's what the Aave brand stands for, of actually having people behind of the technology that care about the safety, and I think that's really important. But in general, we build for everyone in the sense that we think that DeFi will be used by every person on Earth, and DeFi is just a perfect place for having financial algorithms and financial opportunities that can be distributed globally. So I do think that there's going to be a lot of growth, and I think that DeFi is growing also because it has proven itself, and there's very good regulatory tailwind at the moment that has been really helpful. The banks are more open to work with on-ramps, and getting access to DeFi is becoming more easier. And there's a lot of institutional demand at the moment. And I think this whole concept of tokenizations and RWAs are really important because that actually creates the demand side. So if you can use traditional assets as a collateral and you create a interest rate market against these assets, and that creates demand, and that creates a bigger yield market to be distributed across globally.
And then thinking about the unified liquidity hub that the V4 would enable, how do you kind of see that playing a role to unlock more for borrowers and lenders on the other side across chains like Avalanche and then other ones as well?
Yeah, the new model is maybe that good analogy is kind of having like a central bank that is issuing, which is the liquidity hub, that is issuing credit to these liquidity spokes, which are more of like commercial banks. So a spoke is simply a lending, or let's say like a borrow configuration of various different assets and different risk parameters, Oracle configurations that you can attach to a liquidity hub. And then a liquidity hub can actually decide to allocate liquidity. And Liquidity Hub has a governor, so that can be Aave DAO, or that can be an external governance contract sharing economics with the Aave DAO. So it's a way of actually creating and innovating something new. So if you're a developer and you have some interesting ideas in DeFi that you want to build, one of the biggest challenges at the moment is that once you build and innovate, how do you actually grow and get liquidity? So typically what DeFi teams do, they go and contract liquidity. So they go and rent the liquidity out, which has a cost, or they have to somehow partner or market their product. But with these spokes, what you can actually do, you can build something really cool and request a credit line from the Aave DAO, from the liquidity hub, and get instant liquidity directly seeded into that innovation. And it can be just some interesting collateral asset and borrowing configuration. That can be also a RWA collaterals or something completely new as well.
I also want to talk to you about stablecoins. That's an extremely well-made or well-fit product market fit within the industry right now. I know last year we talked about stablecoins and payments and everything else that's happening within the ecosystem, but a lot of things have changed since then. How do you kind of anticipate stablecoins playing a role in the broader DeFi infrastructure landscape, and as well as Aave's native stablecoin in this new V4? Do you kind of see it changing the way we think about payments and cross-border relationships, or what's like the next step here?
Yeah, I think stablecoins, I mean, it provides really interesting utility, right? It creates the stability that you need in a decentralized system that doesn't talk to outside world, right? And I think a really beneficial use case of stablecoin is actually accessing DeFi yield. And to explain what I'm trying to say is that stability means a lot in countries where there's economical instability. So, for example, that's Argentina, certain parts of Africa, Asia, and Middle East. But one thing that is really hard for stablecoins to sell is in the Western world, the stability, because the banking system works pretty well. It gets optimized. It's not what we really want. Obviously, we want a better system, and that's why we're here. And that's what we think that DeFi and blockchains can provide. But really big value proposition in the Western world, in US and Europe, is that stablecoins can give you access to that DeFi yield. And that's the kind of like a tool that you actually need. And that's what we are also betting on. So at Aave, we've reached kind of like the, I would not say we've reached the maxima of DeFi. It's the biggest DeFi protocol, but there's still scaling that we can do on the DeFi user base, adding new interesting assets like RWAs and so forth. But what we're truly interested in actually taking this yield that we have and giving it to people around the world. So how do we get to that consumer adoption and also package that yield for institutions as well? Aave native stablecoin is very fascinating because it is a decentralized alternative, and that has certain type of value. But at the same time, it creates an interesting revenue stream for the Aave DAO. So 1 billion worth of USDC borrowed, actually 100 million worth of Go creates the equal amount of revenue to the Aave DAO. And that excess revenue can be actually used to create higher interest rates for users. And like looking at historically speaking, since inception, Aave has been able, and DeFi in general has been able to beat the kind of TradFi risk-free rate. So I think as interest rates are going to go down, already started in Europe by the European Central Bank, also going down by Bank of England here in the UK. It's going to go down the line by Fed in US. The more interest rate cuts we see, the bigger the DeFi opportunity will be. And that's when we actually have the ability to tap into consumers, but also institutionals, because there is that opportunity and ability to actually move on the risk curve with Aave V4, because you can create liquidity spokes and hubs that have a different type of a risk profile.
I was going to ask you that about the consumer adoption and institutional adoption. I think a lot of times when we talk about, TVL users, et cetera, it really does tie back to crypto native audiences and even crypto native institutions. When you're thinking of people outside of the Web3 ecosystem, you talked about the macroeconomic situation right now, where do you see the potential for adoption from mainstream institutions, consumers, and people who are not necessarily familiar even with the term DeFi?
Yeah, I guess institutions are a little bit easier because with the tokenization concept, there's a lot of value on that. So you will see a lot of asset managers that are already in the space, BlackRock as an example, and tokenizing these funds. So there's a great utility of using RWAs as a collateral, and in fact, Aave's Horizon initiative is perfect for this, because Horizon creates as a first initiative a RWA market where you can use RWAs as a collateral, and that means that you can access 24/7 liquidity against your traditional assets, and that doesn't exist the same way in traditional finance. And then I think that some sort of opportunity of packaging the yield that is in Aave in a more traditional form is going to happen. But the most interesting part is actually the consumers. So there's few kind of like a bottlenecks that has stopped us to go to like a real consumer adoption. And obviously one of them has been the regulatory headwind, which is actually getting better. We have stablecoin regulation coming in as well. Infrastructure, being able to actually scale. Like 2 years ago, transaction costs were very high. So if you think about transaction cost and Avalanche, for example, today, that's truly possible. And the user experience. So we are moving out of the kind of like a world where you have to install a browser extension and write seed words down and do all that, and go to an exchange to acquire, convert a traditional asset into traditional currency into a stable coin, and all that has to disappear basically. And I think that's what is going to happen in the next 12 months, and then you can actually build towards that end consumer audience.
So 12 months till the consumers come in.
At least the first ones. I think it's still like a long process. We need to obviously beat the interest rates in DeFi in a safe way. So we have to have sustainable yield at the same time. And I think it's really a long process. So we're, end of the day, changing finance. It moves slower because we're changing money and how it works. It has so deep network effects, so it takes quite a lot of time. So I would say like it's more of a it starts now, but it's going to be a decade and a half journey.
Okay, it starts now. I like that. Very nice. I'm thinking about the larger DeFi market and then lending protocols in general, maybe taking a step back, but also considering Aave, of course. What do you think needs to be done to optimize for better capital efficiency for both users and then, on the flip side, builders? Remember trying to move your assets between chains, watching the minutes tick by, wondering if your transaction would make it? Yeah, we've all been there. But here's the thing. While other bridges feel like taking the scenic route, Across is your express lane. Base, Arbitrum, Optimism, boom, boom, boom. Your assets move between them faster than you could say cross-chain. Across isn't just another bridge. When Uniswap needed the fastest, most reliable way to move assets cross-chain, they chose Across. Now millions of Uniswap users are swapping between chains without even thinking about it, because that's how it should be. Whether you're moving assets yourself or building the next big thing in crypto, Across makes cross-chain feel like the same chain. No more scenic routes, no more complexity, just 2-second transfers between chains. Ready to join the Express Lane? Head to across.to and experience what bridging should have been all along.
V4, obviously. No, but I do think that I like the approach where there is ability to truly move on the risk curve. So that's always kind of like a balance that we have in DeFi, right? So we are trying to establish the strongest liquidity network effects and capital efficiency. But with that capital efficiency and liquidity network effects, you're compromising then obviously the risk and segregation of liquidity. So that trade-off and figuring out how to balance it really well is really challenging. And I do think that maybe the sweet spot is ability to actually segregate risks, but then have this kind of like a capital allocation model, for example, like the liquidity hubs work, where you can take additional risk and package it into a capital allocator is very interesting. So yeah, and having that optionality is going to be really important.
Yeah, I also think in terms of where we are today versus like previous market cycles, and then you talked about DeFi summer, and then you talked about 2020, and I look at DeFi in such a different point of view every single market, every single year. And obviously the title of this panel is the next generation of lending, and with that comes DeFi, right? How would you categorize what the next generation looks like compared to the current one?
I think pricing is really important component, and we have a good amount of lending and borrowing at the moment. So, and this somewhat ties to that capital efficiency aspect. But one thing we don't really do really well on the lending side is just like pricing the liquidity accurately. And you can see this in a way where, for example, in the Aave V4, if you borrow, let's say Go or USDC, you're basically paying the same rate regardless of your risk composition. So the overall pricing of the liquidity is much more wider and based on a whole kind of like a market. And something that we want to solve in the Aave V4 is ability to just price more accurately the risk without losing these liquidity network effects. And an example for that is a feature called risk premiums, and it means that everyone on Aave V4 is paying the same rate of the borrowed asset, but based on your collateral composition, you actually get a premium on that trade. So what it changes is that if you have a very lean position, so you are supplying, let's say, ETH or AVAX, and you're borrowing a stablecoin, you are in the least riskiest category compared to if you have more complex collateral composition. So you will have to pay more. So what we're trying to do is we're trying to more accurately price the risk. That means that if you have a lean position, you're going to pay less in the future. And then that kind of like risk goes exactly where it should exist and be paid for. And I think that's really important development as well.
What about for Avalanche specifically, do you think is a really appealing opportunity? Obviously, we're at the Avalanche Summit, and there are a lot of people that are building within this ecosystem. How do you see V4 being placed within the Avalanche network, and what kind of opportunities can that unlock?
Now that we have this new architecture, what it really allows to us to do, and also other teams, is to build really exciting things. So we're going to build something really interesting in terms of spokes, but it really opens up the floodgates to innovate. And I could imagine where you have a higher throughput and faster block times and very low cost, you can actually start using lending and credit in use cases such as, for example, trading more efficiently. And there's also payment use cases that you can use. We had a really interesting feature in the past versions of Aave, which is called credit delegation. And I truly think that it's something where I have seen some implementations built where you can give your, if you have certain amount of funds in Aave, you can, and you're just supplying the liquidity, you can actually give the credit line for someone else to utilize for some sort of activity. There's some implementations and use cases for that, but I really want to see more used in trading use cases and payments specifically as well. So there's a lot that can be actually done. But in overall, it's just we're moving to a system where Aave becomes more kind of like an modular infrastructure, and it can be expanded by third-party developers, and that's going to be really cool from like a developer perspective.
You talked about trading and payments as being good use cases. Are there any use cases that you think would not be a fit?
I don't know. I mean, well, I don't know. I would like to say something that, like, I'm not the biggest fan of meme coins, but I think.
Why not?
I think you can still like use meme coins as a collateral in some ways, as a separate spoke. You can borrow them as well against some other collateral. So I do think there's something there. I also want to see some expansion for actual extension of credit and under collateralized loans, and you can do that in a very safe way now with Aave V4 because you can spin out a liquidity spoke and create a system where you're underwriting loans effectively, and then request the liquidity from the main liquidity hub that the Aave DAO is going to run. And I think that's going to be quite interesting. I personally want to see a lot of under-collateralized lending happening, using basically social identity and trying to use attestations and bringing like credit, but in a really novel way. I'm less interested in bringing like the traditional credit systems on chain because I think they're very outdated and really broken as well. But I would like to see some sort of a universal form of credit being built with Aave.
Well, if they're outdated, wouldn't you want them to come in and get revamped?
I mean, it's really interesting because with on-chain, you could actually, you can create something that is truly borderless and that can be consumed by anyone, any part of the world, and just figuring out what is like the connective identity and what that can be actually. And a lot of credit is based on future income expectations or social capital. So there's a lot that can be actually done there. And I think it's a space that just becomes more interesting because, I mean, we haven't really exhausted all the kind of like a collaterals that you have in DeFi, like native assets. I do think like RWAs are going to bring more use cases and collateralization, and that creates further interest rate markets. But I would like to see more of like going just purely lending against credit as well.
Yeah. My last major question before we go to audience questions. So if you have any, I see one hand, you have to wait. I have one more question. But before we go to that, Stani, on the RWA front, you've talked about it throughout this conversation. Where do you see the most opportunity for V4 on the real world asset front that hasn't already been addressed in the broader DeFi market? Or is it to kind of take what has been done already and then make it better?
I mean, for RWAs, like the biggest challenge is that, once you get them on chain, what will you do with them? So it's still like, it's not that useful to use. I mean, it's useful for transparency to use a blockchain as a database, but then the true utility for RWAs is DeFi. Like that's the future. With DeFi, I think RWAs are less interesting, and DeFi needs RWAs to scale the interest rate markets, so they kind of like go hand in hand. I mean, from Aave's perspective, Horizon is going to be the first RWA-focused lending market where you can borrow Go directly against RWA assets and USDC, and hopefully we get this activity to Avalanche. In fact, we're launching and expanding Go into Avalanche in a few days, which is going to be really interesting. But I do think that the utilization of lending and borrowing is such a crucial component for RWAs that they don't really, you can't get the fullest benefit without having interest rates markets, basically. And then I think like what really needs to be solved, and I spend quite a lot of time on this RWA stuff, and I kind of feel a little bit old because I used to be fully DeFi guy, and now I kind of like, I'm looking at RWAs, so I feel really old. But but what I notice is that every single provider has their own type of eligibility requirement, which is fine, but there isn't really a way of actually connecting everything together. So, and you get the same type of a problem where you have to do the same type of eligibility and KYC across different providers. And that creates a lot of friction if you want to swap RWA assets between two different issuers. So I think that's something where I would like to see some improvements, because that will then help to use these assets as a collateral in DeFi and swap them as well on decentralized exchanges.
Okay, amazing. We have some time for some questions. Go ahead. We got a microphone.
I'm curious to understand, how far we are from under-collateralized loans and utilization of ZK for the identity of those? Because in my opinion, this is what would be the driver for the retail users, right? The blocker is still a lot with the supply of the collateral side. So I'm curious if there is any work being done from Aave side, or are you mainly waiting for the industry to kind of provide this infra?
Yeah, I mean, it's I think the retail side of it is definitely important, like the credit extension. I think retail can be achieved on the supply side first, just basically getting this yield into everyone's hands. But then you're right in the sense that there has to be that other side of the trade, which is the consumption, the borrowing. So there's two ways to do that, obviously. Like one is with RWAs where basically a large amount of private credit is, or let's say mortgages are tokenized, brought into on chain, and then you can borrow against them, and that creates interest rate yield basically to distribute to retail. But they're like a true kind of like an interesting, obviously, benefit is that if you can go like direct to consumer and create these opportunities directly for them to on chain, and in the idea of actually creating more competitive environment and more transparent kind of like a lending process as well. I think that most of the things I see is kind of like looking into existing credit systems and how to like connect them together and bring them on chain. And I do think that like the next maybe like couple of years, we'll probably see a lot of credit systems and identity being part of that. And ZK, the ZK proofs are interesting because that's like one of the innovations where you can prove certain type of information without revealing that. The very basic, obviously, that is taking off now is proving that you are 18 years old, but you can go as far proving other types of things, and that could be interesting like a credit system. But I think the next 2 years is a good opportunity because a lot of the collateralized stuff is being built on DeFi and RWAs. A lot of people are working on RWAs, and this is kind of like the last big area of focus and very difficult one to solve as well.
Another question in the back over there.
Thanks. You talk a lot about lending against crypto assets, but you also talk about collateralizing loans, mortgages. How do you, and for a bank in the UK, probably the best borrowers would be farmers looking to borrow to buy a tractor or business property developers. How do you actually persuade those borrowers to tokenize their assets? Because the banks spend quite a lot of money marketing to them.
Yeah, I mean, the most fastest way, an indirect way, is simply taking existing loans or an ongoing credit issuance and buying that and then tokenizing that basically and then using as a collateral to draw more liquidity against and financing these financial institutions to give more loans out. That's the kind of like a more like a scaled version of doing that. And then the other version is basically there should be an opportunity for a market participant to come and actually issuing credit, and then they use their own chain for sourcing liquidity. So you could technically start a credit business with a really direct way of getting LPs, which is on chain, especially if you have a proven system. So that's the one benefit, and then the underwriting part. So I think one option is that we'll see that DeFi is kind of used as a liquidity source, or things like Go stablecoin, where you can use some of this collateral as a way to mint Go and fund these opportunities and convert to the traditional currency and so forth. So I would say like the way to do it is either this kind of like buying a big amount of credit and tokenizing and re-extending credit for those existing financial institutions, or a market participant comes and creates this type of a service based on the opportunity that they have from DeFi LPs effectively. But it's a process. Like you have to, like you start the credit system from the ground up. You know, you have to build the risk models, you have to build the trust and so forth. So we're going to see like a slow but steady growth for those participants until some point that they've been able to prove a good track record.
Awesome. All right. Well, thank you to Stani for all the great insights, and thank you to everyone for listening in.
Thank you.